So picture this. Over the weekend, a major geopolitical scare erupts. Monday morning, the markets open and they're in a freefall, just like you'd expect. But then, something really strange happens. By the end of the day, the major indexes had clawed their way all the way back to finish flat or even green. I mean, it looked like incredible resilience, but was it?
So what was really going on here? That's the question we're going to dig into. At first glance, it looks like a classic case of investors just shrugging off bad news and confidently buying the dip. But if you peel back the layers, a much more worrying picture starts to come into focus.
All right, so let's start with the head-scratcher itself, that absolutely incredible reversal we all saw. What exactly happened? And more importantly, what was really driving that price action?
I mean, just look at the sheer velocity of this turnaround. We started the day deep in the red. The S&P 500 was down over a full percent. But by the closing bell, not only had it clawed back every single one of those losses to finish basically flat, but the tech-heavy NASDAQ actually finished nicely in the green. Now, on the surface, that looks like a sign of incredible strength, but, well, not so fast.
So let's peel back that first layer, because that heroic-looking rebound, it was not a signal of economic health. In fact, it was hiding a huge structural weakness right under the surface, in the market's very foundation. And this slide right here, this gets to the absolute heart of it. The popular story, the myth you could call it, is that the market flexed its muscles and showed its fundamental strength. The reality, though, according to institutional analysis, is that this was a purely technical event. It was a squeeze, driven by the strange mechanics of the options market, not by genuine investor confidence. Okay, to really get what happened, you need to know this term, short covering. Think of it like this. A lot of large hedge funds had already bet against the market before this crisis ever hit, using options as a kind of insurance policy. When the bad news landed, they wanted to cash in on those now profitable bets. And here's the kicker. To do that, they were forced to buy stocks, creating this huge wave of artificial demand that pushed the entire market up.
Now, this kind of forced buying actually has a name. It's what Wall Street pros call a gamma squeeze. It's not driven by people feeling optimistic about the economy. Nope. It's a mechanical, almost automated process that gets triggered when all these large options positions are unwound at once. So think of it as a temporary distortion, not a real vote of confidence in where the market is headed.
And this chart really shows you just how narrow and warped that distortion was. The entire rebound was powered by a desperate flight to safety. Money flooded into just two little groups, the mega-cap tech stocks, the Magnificent Seven, and defense companies. And while they soared, the rest of the market, the vast majority of stocks, actually finished the day down. This wasn't a broad recovery. It was a highly concentrated panic move.
So why the panic? I mean, why the desperate need to hide in just a few names? To answer that, we have to look past the day's headlines to the real villain of this story. The macroeconomic storm that was brewing long before any of this. We're talking about the return of an old economic enemy, stagflation. Now, for anyone who's not familiar, stagflation is pretty much the worst-case scenario for an economy. It's a ghost from the 1970s. It's this toxic mix where economic growth just grinds to a halt, but prices for everything, gas, food, you name it, just keep going up. It's a really painful combination that leaves central banks with absolutely no good options.
And the evidence for this is really starting to pile up. Let's start with the stagnant part of stagflation. The latest GDP figures show the economy is slowing down, and fast. Growth came in at just 1.4%. That's a massive drop from the pretty robust 4.4% we saw in the previous quarter. The economic engine is sputtering, and that directly hits corporate earnings and your wallet.
And then there's the inflation part, the real skunk at the economic party. This number, 70.5, it comes from an index that measures what manufacturers are paying for raw materials, and it absolutely exploded. This isn't just a small uptick. This is a screaming signal that inflation is roaring back into the supply chain. And that usually means higher prices for us, the consumers, are just around the corner.
So here's the bottom line. The Federal Reserve is trapped. The slowing economy desperately needs the medicine of lower interest rates to get going again. But with inflation roaring back like this, the Fed simply can't cut. If they do, they risk making inflation even worse. And the market has definitely taken notice. Any hope for a rate cut this spring has all but evaporated.
So given this really toxic backdrop, how are the big institutional players, the smart money, actually positioning their portfolios? Well, I'll tell you this. They are not buying the dip indiscriminately. They are making very specific, very strategic moves.
And this table right here,
This shows you exactly where that money is going. There's a clear rotation happening. You can see capital is flowing out of sectors that just get hammered by inflation and high fuel costs. Think about airlines and consumer goods. And where is it flowing? It's going into what you might call wartime assets, energy companies that benefit from supply shocks, and of course, defense contractors.
At the exact same time, the US dollar is getting stronger, and this creates this powerful vacuum effect. As risks rise all around the world, global capital flees weaker economies and rushes into the perceived safety of the US dollar. It basically sucks liquidity from everyone else and makes it way harder for other countries to manage their own economies.
This means the very definition of a safe haven is changing. It's not just about government bonds anymore, especially with inflation being such a huge threat. Smart money is now hedging with a whole basket of assets: the US dollar, gold, energy, and yes, even Bitcoin. They're looking for protection not just from conflict, but from the threat of inflation and central bank policy mistakes.
Okay, so that's the diagnosis of what's happening. What's the prognosis? Well, looking ahead, institutional strategists basically see two main potential paths forward from this really critical moment.
Okay, scenario A is the bullish case. The conflict de-escalates quickly. The key sign you want to watch for here is the price of oil falling back below $70 a barrel. If that happens, you could see a sharp rally in some of those beaten-down growth stocks. Scenario B, that's the bearish case. The conflict drags on. If Brent crude oil breaks and holds above $90, that's a major warning sign for the global economy. In that world, cash, gold, and defense stocks become the go-to assets.
But there is a wild card here, a potential black swan event that the market might be completely ignoring. The real danger might not even be the conflict itself, but the fragile and largely unregulated world of private credit. You can think of these as massive, under-the-radar loans to companies. Now, if stubbornly high interest rates cause a wave of defaults in that space, it could trigger a fire sale across all asset classes.
So let's bring it all together. The final verdict from institutional strategists is neutral to bearish. And the key takeaway is simple: please don't be fooled by that one-day rebound. The combination of rising geopolitical risk, rising oil, and rising bond yields, it's a toxic mix for stock valuations. The foundation for a real rally just isn't sustainable right now.
And this really puts a fine point on it. The old Wall Street playbook, the old saying, was to buy stocks when a war starts, on the assumption that uncertainty is at its absolute peak. But this time may be different. The underlying threat of stagflation means the Fed can't just ride to the rescue with cheap money like it used to. In this new reality, the smarter move might just be to secure your cash and wait for the dust to truly settle.